Welcome to Surviving the Credit Crisis, a show designed to give you the tools you need to survive any credit crisis. Here's your host, Karen Simpson Hankins.
We live in a greedy little world that teaches every little boy and girl.
Hi, and welcome back to another exciting episode of Questions and Answers here on Surviving the Credit Crisis. And we have just got dozens of questions this week. And for some reason, there was a huge majority of them that came in regarding credit. So I decided to dedicate this show to the credit questions because we couldn't get them all in a half an hour show. So today we're going to be talking about credit questions, and then we'll pick up the rest of them on next month's show. So today my guests are my assistants, Melissa and Heather. Good afternoon, girls.
Hello. Hi.
Hey, I'm so excited that you're here with me today to help me out with these questions. And I know that you've both been working really hard keeping up with them on Facebook and some of the social media sites. So what's our first question today?
Okay, our first question is from Facebook, and it asks, what are public records on a credit report?
Oh, that's a great question. Public records on a credit report usually consist of judgments, bankruptcy records, and federal and state tax liens, anything that's of public record, just kind of like it's called. And to give a little bit further clarification about what a judgment is where some private individual or a company or someone has actually sued you in court. And the case can be pending or it can be resolved. And both of those situations still show up on your credit report, and they will show a balance due or a balance paid. Our next question?
This one is talking about the judgments. How do judgments end up on your credit report?
Well, there's a lot of misconception about judgments and what judgments actually are. And, if you are sued in court, it's the court that files the judgment against you, not the private individual. And once that judgment is filed against you, it may not be long before it ends up on your credit report, because most of your credit reporting agencies will report judgments, but they don't get them necessarily from the courthouses or the county clerks. They get them from public record providers, like a company called Pacer. And when those public records are posted, then the credit bureaus add them to your credit report. And depending upon what type of a judgment it is, determines how long it stays on your credit report. The majority of the accounts that end up on a consumer's credit report, like mortgages, credit cards, collection accounts, etc., are all reported to the bureaus by either the actual lender or a collection agency, which is also known as a data furnisher. But again, the courthouses and county clerks or court clerks, they do not do that. They just provide that information to a public vendor website, and then that's how that information is accessed. Question number 3.
This one is from Jessica. How soon can a bankruptcy be removed from your credit report?
Well, there's a lot of times when I'll ask a customer if they've filed bankruptcy in the last 7 years, because from a general set of circumstances, a lender it'll impact your ability to buy a house or get a loan for up to 7 years. However, bankruptcies can be reported by the credit bureaus for up to 10 years. And there's a little bit of controversy as to how that actually happens. And primarily, depending upon whether you're talking about a Chapter 7 bankruptcy or a Chapter 13 bankruptcy. Now, a Chapter 7 bankruptcy, and I don't want to get into all the differences between the two at this point, but the Chapter 7 bankruptcy is a charge-off of all of your accounts, and that were included in the bankruptcy. And the Federal Credit Reporting Act usually indicates that the maximum amount of time that a Chapter 7 bankruptcy is allowed to be reported is 10 years from the date the bankruptcy is filed. So just because a lender only asks you if you filed in the last 7 years, in all likelihood, it's still going to show up on your credit report for up to 10 years and have an impact on that credit score. Now, with a Chapter 13 bankruptcy, they're required, well, let me explain the Chapter 13 just briefly. Chapter 13 bankruptcy allows consumers to stop collection procedures while they restructure their debts. And they actually enter into a repayment plan for about 3 to 5 years. On Chapter 13 bankruptcies, they're not discharged until that 3 to 5 year repayment plan is completed. So when the credit bureau says that the Federal Credit Reporting Agency says that they can only be reported for 7 years, a lot of times they're talking about 7 years from the discharge date. So if it takes somebody 3 to 5 years to pay those debts back, that discharge date is going to be a date a lot later than when it was originally filed. So it is conceivable that that bankruptcy could also end up being on a credit report for 10 years because it was filed and then it took them 3 years to 5 years to pay. That was kind of a complicated one. Question number 4.
Question number 4 comes from our blog. How do credit card balances impact my credit scores?
Well, credit cards are a kind of a unique situation in themselves. And, actually credit cards can help your credit score or they can hurt your credit score, primarily whether they're paid on time or if you keep a high balance. And by that I mean your utilization versus your high credit balance. So let's say, for an easy example, that you have a $2,000 limit on your credit card. And if your balance is consistently above 50% of that credit limit or $1,000, there are big deductions in credit score for being over 50% of your credit utilization. So if you can pay down that balance on a credit card to get it down to below that $1,000 mark or that 50% level, you're going to see your credit score go up. Also, if you could keep it down into the 25% level, so let's say you have a balance of $500 on a $2,000 credit card, that lowers the risk and will also have a huge impact on your credit score. So your credit score will go up if you have a lower utilization score. Now, credit card debt also has the ability to negatively impact credit scores even when that monthly payment is paid on time. So most people think that as long as they're paying their credit cards, they're okay. And I've seen people go out and get a secured credit card in an attempt to reestablish credit, let's say after a bankruptcy or whatever, and they've gotten let's say a $200 secured card. And what a secured card is if you put a deposit down for $200, then the lender will give you credit for $200 because you have a secured balance sitting there. And then that gives you the opportunity to reestablish some credit. But you have to be careful in that kind of a situation, again, because of that utilization percentage. If you charge more than $100 in any month and you keep that balance up above the $100, then it can have an impact on your score. So, smaller can be better. It doesn't really matter the amount that you charge monthly. Let's say you charge $10 a month or $20 a month and pay it off every month. You're building more months of history, and it will give you more impact or improvement on your credit score. How about the next question, girls?
Okay, the next question is from a man named Jason, who asks, how can I improve my credit score?
Well, there's lots of ways that I counsel my customers on improving your credit score. I think first I want to talk a little bit about the fact that a credit score can range from as low as 300 to as high as 850. And if you don't know what your score is, it's important that you find out. And so the higher your credit score, the lower the risk of default with a potential lender, and it will improve your buying power. There's several different ways that credit scores impact your ability to buy, not only from the whether or not you get a loan or not, or if you have a lower credit score, a 20-point difference in your credit score can have a huge impact on the price you pay for that credit. Like on a mortgage, the optimal credit score is 740. Anything above 740 is considered premium pricing. Now there's an add-on to pricing from 720 to 739, and that add-on to pricing gets bigger with every 20-point drop in your score. So there might be a quarter add-on from 720 to 740. It might be a half from 700 to 719, and the lower the credit score, that bigger add-on to pricing. And it can literally amount to anywhere from a quarter to 0.3%, maybe even a 0.5% difference in interest rate, depending upon what your credit score actually is. The trade-off for that is that you either have to pay a higher loan fee or get a higher interest rate. And most of the time, people just don't have an extra 1% or 1.5%, or I've seen add-ons to pricing for lower credit scores as much as 3.25%. And, on a $100,000 loan, that's $3,200 extra in fees. And most of the time, people just won't have that extra money, so they will raise the interest rate to compensate for it. Another example that I can give you is what kinds of things contribute to your score. 35% of your score reflects late payments, collection, your public records, and your past due accounts. Now, even a 30-day late on one credit card isolated has an impact on your score as much as, 25 to 35 points. It just depends. So it's important to pay those monthly payments on time to help protect that credit score. 30% is outstanding debt balances. 15% is length of credit history. So the longer credit history you have, the better your score. 10% comes from credit inquiries, and 10% from other types of credit in use. Now, credit inquiries is something that I get asked about a lot because people are getting more and more aware that an inquiry can impact your credit score. Now, there's what I call soft pulls and hard pulls, and that is, a soft pull is when someone that you're banking with presently, they may update your credit every so often just to make sure that there isn't anything that's unusual that's popped up since the last time they reviewed your credit. And a lot of times those are considered a soft pull. Another example of a soft pull would be if an employer or employer does pulls a credit report as a pre-employment interview. Those usually do not impact your credit score, or possibly even with an insurance company or someone like that. Those usually do not reflect your credit score. However, a hard pull is when you actually go out and shop for credit. And so there's all different things to take into consideration when you are shopping. If you're going around from car dealership to car dealership, every time they pull your credit, that's going to show up as a different credit report, and it can have an impact on your score. Sometimes with a mortgage, if you're shopping for a mortgage and you do several different credit or mortgage lenders within a 30-day period, then they only count it as one pull, and it won't have as big an impact on your score. But it can if it's not handled correctly. So that's a question you always want to ask. So what's our next question?
Casey from Facebook would like to know, what is a good credit score?
Well, I touched on that just a minute ago, that for mortgage purposes, 740 is the target score that you want to shoot for, and to get premium pricing. And there are add-ons to pricing for just about every point drop in your credit score. So your cost is going to be higher if you're in the 700 to 719 range. It's going to be higher from 720 to 739 range. When you get down below 700, those impacts or add-ons to pricing will get bigger. I think that the average credit score is about 680. Some lenders out there won't lend to anyone that has a credit score less than 640, but I'm starting to see a few specialty programs come back now that are offering loans available to anyone with a credit score as low as 600. Some of your FHA programs now allow credit scores as low as 600. The trade-off is you're going to pay a lot higher interest rate. So a lot of times it's in your best interest to go ahead and do some work and get a copy of your credit report. See if you can get that credit score improved prior to making an offer on something, because it's too difficult to try to improve your credit score within a 30-day closing. Let's take a break for just a moment and thank my sponsor. Real estate is an increasingly complex, highly competitive, and fast-paced industry, and tomorrow's professionals require advanced knowledge and training to excel in this field. Graduate studies in real estate are in demand more than ever because an MBA in real estate can open doors to greater job and career opportunities. Developed especially for working real estate professionals, Longwood University's new online MBA in real estate will take you to the next level. Check out their link on my show page. If you want to learn more about me and any of my homebuyer programs, you may go to KarenSimpsonHankins.com. You can also find me on Facebook under Need Mortgage Info Now, where I'm fighting the industry for you. So just to recap a little bit for today, we are having our monthly question and answer session here on Surviving the Credit Crisis, where you, the consumer, can write in by email. You can ask us on Facebook, LinkedIn, or any of my social media sources, or actually even give me a call if you've got a question that you want answered. If you need an answer right away, probably the best way to get your answer answered quickly is to follow me on Facebook, and that's at facebook.com/Need Mortgage Info Now. So, girls, do we have any more questions left today?
Yes, we have 3 more questions.
Great. Well, what's the next question?
The next question is from Jenna. She asks, I recently got married and my spouse has credit issues. How does my spouse's credit affect me?
Oh, I'm so glad you asked that question. Many couples are uncomfortable talking about their individual financial situations. And, it's good to be upfront and open about everything so there's no surprises down the road. There's money management tips that you can get all over Google or whatever to help with that kind of a thing. I can tell you how it will affect your loan is that when you apply jointly, especially on a home loan, most of your lenders will you have 3 credit scores. You have TransUnion, Experian, and Equifax. And each person has 3 scores. Well, they will use the lowest score of the 2 borrowers, actually the lowest middle score of the 2 borrowers. So let's say, for example, that the husband has a 735 middle score, but the wife, for example, has a 673 middle score. They will use the lowest of those 2 or the 673 for pricing. So even after you're married, you and your spouse will have separate credit reports. And the only way you'll share in each other's credit is if you apply jointly. So a lot of times, if one spouse has bad credit, then you may have to apply as an individual and not jointly. Okay, Melissa, what's the next question?
The next question is from LinkedIn and asks, How does paying off debts or closing accounts impact my credit score?
Well, closing old credit card accounts can impact your credit score, but not in the way you might think. Canceling old credit accounts can actually lower your credit score. When you close accounts, it's important that you take into consideration how much credit history you're going to have left. Because if you close older credit cards, even if they have a zero balance, and it shortens your history, that shorter credit history can have a negative effect on your scores, because lenders like to see, an established pattern of responsible credit to use for your report, and that's factored into your actual credit score. The next question?
Okay, our last question is from Juan and asks, how does a short sale affect my credit?
Oh, that's a question I get asked all the time. With the recent credit crisis, there was a lot of people found that their values were much lower than what they originally were when they bought. And so they're upside down, or what we call underwater, where their mortgage balance is higher than what they can sell the home for. And that's exactly what a short sale means. It means you're selling your home for less than what you owe. And that can affect your credit score, but there's two things that are important. One, you have to get permission from a lender to sell in a short sale, and so they have to agree to it. But in addition to that, there's a possibility that whatever that short sale amounts to balance-wise can be a tax liability. Now, I know in the past there was a forgiveness law, but it's my understanding that forgiveness law has since gone away. And so before you agree to any kind of a short sale, it's important to check with your accountant to make sure that you have an idea of how you're going to be affected from a tax point of view. As far as strictly just your credit score, it's going to suffer some damage, and it depends upon how the lender rates it. If it's considered a charge-off, then it's going to have a bigger impact than if it just indicates that it was settled for a smaller or lesser amount. Now, it's my understanding that August 16th, Fannie Mae is coming out with a revision to their waiting period on a short sale as well. We had been told that up until now that if you waited 2 years after a short sale and your loan to value was 80% or less, where you had 20% down, that you were eligible for financing again. Well, we've been told that as of August 16th now that the waiting period is going from 2 years to 4 years, which makes it really kind of sad, because there's people that's been out there waiting for 2 years and they think they've just about got to their anniversary date, and now they're going to be hit with an additional 2 years more that they have to wait. So it sounds like that just about wraps up our questions for today. Is that correct, Melissa?
Yes. Questions are done.
All right, great. Well, listen, I want to thank you all for joining me today on Surviving the Credit Crisis. Thanks, Melissa and Heather, for having such great questions. I appreciate all you do for me as my marketing team. But I want to thank my audience for joining me today on Surviving the Credit Crisis. And I know in my heart that together we can all change our financial future one house at a time.
Of money and fame. Ka-ching.
Appreciate all you do for me as my marketing team. But I want to thank my audience for joining me today on Surviving the Credit Crisis. And I know in my heart that together we can all change our financial future one house at a time.
Of money and fame. Ka-ching. Ka-ching.